Ever wonder how our currencies evolved from ancient gold coins to the digital currencies of today? From the dawn of civilization to the rise of cryptocurrencies, this story is packed with fascinating twists, technological breakthroughs, and the shifting rules of trust and power that have shaped our world. Don't forget to hit that subscribe button and ring the bell so you never miss an episode. Let's dive into the epic evolution of money. It's more than just currency, it's the story of human innovation. Ready? Let's go! Back in the days when the concept of money was still taking shape, the earliest forms of wealth were tangible and scarce. Gold and silver, due to their rarity and durability, became the backbone of monetary systems for thousands of years. These metals had intrinsic value. People trusted that they could exchange gold and silver for goods and services because of their physical properties and limited supply. For centuries, these metals served as a stable store of value, a reliable medium of exchange, and a unit of account. Coins made from gold and silver were stamped with images and symbols, signifying authenticity and value. The scarcity of these metals meant that the currency was inherently sound, until, of course, rulers and governments started to manipulate the system. The problem of inflation and government intervention. Early on, governments and monarchs found ways to subtly alter the value of their coinage. Shaving the edges of coins, a practice called clipping, was common, gradually reducing the amount of precious metal in circulation. While such deception was often covert, it introduced inflation and eroded public trust. The advent of paper money marked a significant milestone. Initially, banknotes represented a claim to a certain amount of gold or silver stored securely in vaults. These notes were easier to carry, store, and trade than heavy metal coins. As the centuries progressed, governments began issuing paper money backed by precious metals, reinforcing trust in the currency. The real turning point came in the 20th century. In 1933, the Great Depression prompted drastic economic measures worldwide. Then, in 1971, U.S. President Richard Nixon announced what is famously called the Nixon shock. The United States would no longer convert dollars into gold at a fixed rate. This move ended the Bretton Woods system, effectively decoupling the dollar from gold and ushering in what we now call fiat currency. Fiat money is currency that has no intrinsic value but is declared legal tender by governments. Its worth relies solely on public trust and the backing of a stable government. While this system offers flexibility for governments to manage economies, it also opens the door to excessive money printing and inflation. The consequences of excessive money creation. Since the Nixon era, successive U.S. presidents and governments have increased the money supply, often to fund wars, social programs, or to prop up economies during downturns. While this may stimulate short-term growth, it also dilutes the value of existing currency. Every time more money is printed, the purchasing power of the dollar decreases, a phenomenon known as inflation. This process isn't unique to the United States. Countries like Venezuela, Zimbabwe, Lebanon, and Argentina have experienced hyperinflation, where prices skyrocket and money becomes practically worthless. Citizens in these nations are forced to carry stacks of banknotes just to buy basic necessities, illustrating the dangers of unchecked monetary expansion. The evolution. From bartering to currency. Long before money, humans engaged in barter, exchanging goods and services directly. For instance, a farmer might trade wheat for a shoemaker's shoes. However, barter had limitations. It required a mutual desire for the goods exchanged and was often inefficient. The need for a more universal medium of exchange led to the emergence of money. Different societies used various items: cowrie shells in West Africa, giant stones on Yap Island, clam shells in North America, and animal skins or salt in other regions. These were early forms of commodity money, valued for their acceptability and scarcity. The birth of coins and metal currency. Ancient Chinese and Lydian civilizations pioneered the use of metal coins. The Lydians, around 600 BCE, minted the first official coins from electrum, a natural alloy of gold and silver. These coins bore images and symbols indicating their denomination, simplifying trade and fostering economic growth. Coins became a standardized and portable form of money. The Chinese, for example, transitioned from using cowrie shells to paper money around 700 CE, recognizing the limitations of metal coins, heaviness, and difficulty in verifying purity. The rise of paper money. Paper money, first appearing as promissory notes, revolutionized commerce. The Chinese jiao tu, dating back to the 11th century, was one of the earliest forms of paper currency, representing claims to precious metals stored elsewhere. Banks and merchants adopted paper notes because they were easier to carry and exchange. Europe gradually adopted paper money during the Middle Ages, with banks issuing notes backed by reserves of gold or silver. Over time, governments took over the issuance of currency, establishing national mints and standardizing notes. The gold standard and Bretton Woods. The 19th and early 20th centuries saw the gold standard dominate monetary policy. Countries pegged their currencies to gold, ensuring stability and limiting inflation. Yet the system was fragile, gold reserves were finite, and economic shocks could cause crises. After World War II, the Bretton Woods Agreement created a new international monetary system. The US dollar became the world's reserve currency, convertible to gold at $35 per ounce. This arrangement fostered global economic recovery, but was ultimately unsustainable. In 1971, President Nixon terminated the dollar's convertibility into gold, marking the end of the gold standard. Since then, currencies have been fiat, backed only by government decree and trust. The age of digital money and cryptocurrencies. Today, most money exists as digital records, bank balances, electronic transfers, and credit card transactions. The extensive printing of fiat currencies and the rise of central banks have set the stage for the next phase, digital currencies. In 2008, amid the global financial crisis, an anonymous individual or group under the pseudonym Satoshi Nakamoto launched Bitcoin. Bitcoin is a decentralized digital currency operating without a central bank or government. It employs blockchain technology, a transparent, tamper-proof ledger maintained by a network of computers worldwide. Bitcoin and other cryptocurrencies challenge traditional monetary systems. They offer peer-to-peer transactions, lower fees, and increased privacy. Critics warn about volatility and regulatory uncertainties, but the innovation has sparked a global debate about the future of money. From the earliest days of bartering to the complexities of fiat currencies and cryptocurrencies, money is a mirror of human civilization. It embodies our collective trust, technological progress, and economic priorities. As we stand at the crossroads of innovation and tradition, the question remains, will we continue to rely on governments and central banks, or will we embrace a new monetary system driven by technology? The answer may define the next chapter in the story of human economic development.